You think you have a revenue problem. However, if you're not at 15 to 20% net profit, revenue should be the least of your concerns. This is the biggest financial lie home service business owners tell themselves. I am Paul Maskler. I'm a fractional CFO for $2 to $20 million home service companies. In this video, that's what we're going to walk through. I'm going to walk you through the biggest lie in home services, as many of you probably heard one time or another. Revenue is vanity, profit is sanity, and it is so true. I have a question for you. Have you said either of these statements in your business ownership career? Number one, if we just grow revenue, everything will then be fine. No matter where you're at, if you're at $1 million and you say, once we get to $2 million, everything will be fine. I am here to tell you that is false, because then I talk to just as many $2 million companies who tell me the same thing. Well, I'm at $2 million. And once we get to $3 million, everything will be fine. My expenses will finally be a lot less. My revenue will be higher and my bottom line will grow. I'm here to tell you that is also false. Or the other statement I hear a lot, once we get there, wherever there is, then we'll start to focus on profitability. In the meantime, I'm just going to keep, quote unquote, reinvesting in my business. And that statement, you've probably heard me before if you follow the podcast or YouTube channel. That statement drives me nuts probably more than most, because then I ask, well, what are you reinvesting in? And then what is the return on that investment? And usually it's cricket. So no matter where we are at, the response is going to be the same. It will not solve your problems, number one. And number two, we're never going to get there because we're going to run out of money. We're going to be too stressed, and we just won't be able to actually have the cash to get to the next level. We will run out of money. More revenue simply means more expenses without margin discipline. Let me say that again. More revenue simply means more expenses without margin discipline. If you do not have margin discipline now, basically, if you're not profitable now, what makes you think you'll be profitable later? And studying all the financial assessments that we have done here, well over 100 by now, profitability drops as a business grows. And the reason for that is, from a margin standpoint, the reason for that is when you're a one-man band, you're probably actually pretty profitable on the books because you don't have a lot of expenses and you're making money and there is no overhead. There aren't other employees. You're not spending a ton of marketing. You're getting a lot of word of mouth and referrals because everyone now knows you're on your own. And as we start to grow, our margins kind of go a little sideways. So more revenue simply means more expenses without margin discipline. Without margin discipline, you are simply going to be doing, call it twice as much work. If you go from 2 million to 4 million, if you're not profitable at 2, you're not going to be profitable at 4. So you're going to do twice as much work for probably less money. And a lot of times that's where I meet my clients at in their business journey, is they're kind of, as Dave Ramsey says, they are sick and tired of being sick and tired. Our average client that we work with at Blue Collar Business Advisors is around $4.5 million in revenue. When they come to us, I ask them, would you rather be doing $4.5 million at your current net profit, which is usually on average 4%, call it 180,000 bottom line in dollars, or drop to $3.5 million, but be at 20% net profit? If you're $3.5 million and 20%, you're making $700,000 a year a net profit, which is about 4 times as much as if you were at 4% at $4.5 million. So even though your revenue dropped, your bottom line goes up significantly because you're running a much more efficient business. Now, I don't want this to come across as, well, just start cutting things and then you'll be profitable. It never works that way. It's kind of the same thing. If we're not profitable here, if we're going to keep operating with the same habits that we have, even if we go smaller, we're still going to have the same problem. And then we're going to scale back up and be at the same place because we haven't fixed the fundamental issues. So the ironic thing is, even if we, quote unquote, wanted to get to $3.5 million the right way by focusing on all the things that are important, our revenue actually very rarely drops because A, we get priced right. So now we're actually pricing things properly, which sometimes will improve revenue. A lot of times it does, because we still haven't fixed our pricing from when we went from a one-man band to a small team. We're going to actually free up a lot more time to deliver a much better customer experience, a much better employee experience, which is also going to drive revenue. It's going to drive leads. People are going to be talking about us, and it's going to free up more money for marketing if we have to get there. If we need marketing to get there, sorry. what I've learned with all of our clients that are doing really, really amazing things now is a lot of times I'm telling them, hey guys, just in case, if you need it, there is money for marketing to be spent. Because we start doing all the right things, we actually have to spend a lot less on marketing instead of just trying to get more leads because we are just fighting fires all day and we don't know how to maximize, be productive, and be efficient. So there is a big difference between being busy and being productive. Most business owners are super busy, but they are not productive at all. We are professional firefighters doing just enough to survive and pay the bills. But the truth is, profit has to be designed into your model. And if anybody's read the book Profit First, I love all the theories in there as well and the strategies in there. If we don't price in profit, which most businesses don't, or they think they do and there's still no money left, it's because they're still not pricing properly. We need to start looking at profit as an expense. I want your mind shift to start changing here, that what we need to make at the bottom line is just another expense that's going to you, the owner. It's your payment. It's your payment for taking risk. It's your payment for putting time in to build the business. It's your payment for building a business that nobody else could build. There is a reason most people work for somebody else, because it's really hard to be a business owner. So with all that being said, what do we actually need to start doing? So I'm just going to kind of walk you through what we do with our clients, and you can implement this on your own. When we start working with our clients, it usually gets broken down into 3 bigger overarching themes or steps. So the first thing we do is we make sure our data is clean. If you do not have good data, you don't have good numbers, you don't have good KPIs, then we don't really know what we need to do. If we want to start transitioning our business into a business that it operates based on numbers instead of emotion, ego, and intuition, we first need to make sure our data is good. So your P&L and your balance sheet should tell a very clear story. We should be able to know what the biggest issues are. We should be able to know what our gross profit is. We should know what our marketing spend is. We should be able to know what our overhead is. We should be able to know what are all our liabilities and what are all our assets and how is this business running. Now, you do not need to be a financial expert. I tell all of our clients that you don't need to be a financial expert. However, you own this business. Many times 100% of your net worth, 100% of your value is tied up into this business. If that's the case, we should know how it is doing. If we're going to go buy stocks on the stock market, it's no different than buying stocks into your business. Right now, you are the only shareholder in your business. We need to start acting like a shareholder. When we go to buy stocks, we don't go buy stocks of companies that break even. We go buy stocks in companies that are making money consistently because the value of the stock goes up. Maybe they pay some dividends. Maybe they do a stock split. But over time, if we buy into businesses that are doing really well, we don't care about taxes. We just want this thing to go up in value. So first, we got to get our data cleaned up. Again, you don't need to be the financial expert. More often than not, our clients are the technicians that started the business, or they bought the business and still aren't experts, in the financial aspect of it. And that's okay. So you don't need to be an expert in it, but you do need to take ownership of it and really understand from a financial standpoint what's working and what's not working in your business. So we got to get that data cleaned up. Work with your bookkeeper to make sure everything is in the right place so you know what your gross profit is. What is gross profit? That's what we're really going to go into the second thing here is we need to build a financial foundation that is very solid. Before we go build anything higher, first we need to make sure the foundation can support that. Most home service businesses do not have a solid financial foundation right now. So if you go get more revenue, the foundation is going to get weaker and weaker, and eventually it's going to crumble. So when we have our data clean, we can then start to build the strong financial foundation. So what does that look like? And again, you can take this step 2 and kind of go back into step 1 to get your data cleaned up. But what does solid financial foundation look like? If you just keep it super high level, you can do this on your own. You can look at your P&L, and there are main categories, main themes in your P&L. The first is revenue. We know what revenue is. We don't need more of it if there's nothing left at the end of the day. First, we need to make sure we're making money on the revenue we're doing today. So the first big thing is cost of goods sold. So what is cost of goods sold? Cost of goods sold is what it costs us to deliver on the service we are selling. The main few things there are going to be your labor and your material. Now, not all of your labor, not people answering the phone, not your dispatch, not your CSRs, not your service managers. It's going to be people out in the field delivering your services. So it's going to be our service techs, it's going to be your installers. Sometimes we include our apprentices in there, all of our labor, and then all of the material and products and equipment that we are selling to our clients. All of that makes up cost of goods sold. I've talked about it many times. There's plenty of videos, plenty of resources out there. But we need our cost of goods sold to be between 40 and 50% of our revenue, which means our gross profit, which is revenue minus cost of goods sold, our gross profit is 50 to 60%. So we have that 50 to 60% left over to cover four main categories. Number one is office payroll. What does it cost to pay all the people in the office, including yourself, if you're not out in the field anymore? What does it cost? Then we have overhead. Overhead's going to be our rent, our utilities, our software, our vehicles, all the things that we got to pay for regardless of what happens in the field. Then we have our marketing. Marketing's pretty self-explanatory. What are we doing from a marketing and advertising standpoint to ensure the phone continues to ring? And then last, but definitely not least, net profit. So we've got to take that 50 to 60% of gross profit and divide it up into those four buckets. Office payroll, my recommendation is between 10 and 12%. So if you have a $5 million business, 10% of that is going to be $500,000. Overhead, we talked about what it is. Our targets are between 10 and 15%. So we have a little bit bigger window here because it really depends on where you're at in the business. What type of vehicles do you need? So we give a little bit more leeway. 10 to 15%. So if you have that $5 million business, again, it could be anywhere between $500,000 and $750,000 in overhead. Next is marketing. Marketing, pretty self-explanatory. There are a lot of levers we can pull to lower our marketing spend without hurting revenue, but we want to keep this between 5 and 12%. Again, these are my opinions. Everybody might have a little bit different opinion, depending on how strong your brand is, depending on your goals, depending on how good you are on all the other things operationally, between 5 and 12%. I will tell you, the best businesses spend a lot less in marketing than the bad ones. The best businesses have a really good brand, really good call booking rate, really good field closing rate, really good average ticket, really good retention, really good re-engagement, really good membership programs. All these other things go into driving down our marketing spend as a percentage. And then last, but definitely not least, net profit. Most home services are below this threshold. So we want to start between 15 and 20%. We want to get to 15 to 20%. Now, we're not going to get there overnight. It takes time to change things in business. The key, though, is we need to get started today. The best time to plant a tree was 20 years ago. The second best time is today. Our net profit should be between 15 and 25%. If you are not at 15%, don't think you're going to get to 25 right away. If you're at 4, you're probably going to go to 8, and then you're going to go to 10, and then 12, and 14. You're going to work your way up, and then eventually it gets a little bit easier, And if you're a $5 million business, I tell this to all our clients, if you're at $5 million and you pick up 1 percentage point, that's $50,000 straight into your pocket. So that's step 2. And then, so step 1, we got to get our data cleaned up. Step 2, we need to build that solid financial foundation and track these things on a regular basis. Revenue, cost of goods sold leads to gross profit, office payroll, overhead, marketing, and net profit. Once we've done all these things and we're hitting those targets, it's going to be a lot easier to scale. We're really going to be able to kind of accelerate where we want to go now that we actually have cash in the bank. Going back to the topic of this, the biggest lie we tell ourselves is more revenue is going to solve the problem. More revenue is going to solve the problem only if we are already profitable at the current rate. So that is step 3, is scale. Once your numbers are trending where they need to be, it's time to scale. Step 1 and 2 are super duper boring. Getting our data cleaned up, super boring. Looking at numbers, super boring. Scaling, super fun. However, if we don't do number 1 and 2, we will not have much fun and we will be stressed in perpetuity. So if we're going to be stressed either way, we might as well be productive instead of just busy. That's all I got for this video. If you are ready to stop guessing and you want to actually see what the numbers are telling you, book a right fit call with me today. What does that mean? We're going to dig into your business, determine if it's a right fit, determine if you need a CFO, determine what's working in your business, what's not working in your business, and then we're going to do a financial assessment and figure out what's actually causing the problems and what are the opportunities you have in your business. I'll show you exactly where the cash flow is leaking and what to do about it. The link's in the description. It's in the bio. You can go to the bluecollaradvisors.com, all sorts of places you can go. But thank you so much for checking out this video today. We'll talk to you guys soon.